Swayam Prabha. Digital India. Educated India.
Okay. So, in the previous class we talked about the capital market theory 1, and here what we have observed, that what we have seen, that capital asset pricing model is the uh, founding theory which explains the concept of required rate of return, or the calculation of required rate of return with certain assumptions. And here what we see, that there are certain factors, there are certain variables which basically we should know or we should determine before using this capital asset pricing model to calculate the expected return of the asset or expected return of the equity. So, if you see those kind of variables, and again those variables are not exogenously determined. I hope you should know what is the meaning of exogeneity and what is the meaning of endogeneity. What basically we see, that if exogenous means there is certain, or in general we call it the independent variables which is outside the system. We can make certain changes with that, or it is free for the regulator, it is free for the investor, it is free for the authority to play with that particular database. At any moment they can change it or they may not change it. But if it is endogenous, then we cannot change it without choosing or without changing some other variables. That means, in general we can call it endogenous variable is nothing but that is the dependent variable. So, if this dependency is there, or to determine certain variable, if we need certain other variables, then it is very difficult to use that. So, that is why whenever we use the capital asset pricing model, we have certain things which is used for to, or used to use this particular model. And what are those things? And one thing is already we have seen, that is your risk free rate, then we have the risk premium, then we have also the market risk, or we can say beta, the systematic risk, beta or systematic risk, or any name you can give for this. So, what generally we can see here, that when we calculate this thing, or when we use this capital asset pricing model, we should always know that what is the risk free rate of return and what is the better proxy for this, and how the risk premium can be calculated, and how the beta or the market risk also can be calculated. If you know all these three, then only the capital asset pricing model can be used. But here those are also not exogenously determined. There are certain variables again determine these three variables. So, which are the things, or which are the variables which affect this, and how these particular factors basically determined to use in, to be used in the capital asset pricing model to calculate the expected return of the equity or the stock. So, market risk premium, if you start with, what is this? It is nothing but it is basically the extra return what the investor wants to take the risk in the market, because already we know that there is a risk return trade off. If somebody wanted to take more risk, then the return also should be maximized. So, therefore, whenever we talk about the premium, that means somebody wanted to take more risk in the market, that is why he needs more premium above this. So, any risk premium, basically whatever we talk about, this is above the risk free rate of return what we always have without any risk. because the risk free rate of return is basically without risk. So, if you are taking more risk, the benchmark is always the risk free rate of return, because any return what exactly extra you are getting for investing in this particular asset, which is more than the risk free rate of return, that is basically the risk premium. So, it is calculated as the difference between the average return on stocks and the average return from the risk free rate. Already I told you that the it is, that is why the risk free rate of return is the benchmark return, because without any risk we are getting this much return. So, if you take more risk, then what should be the more return out of that. So, that is basically defined as the premium, because we are taking more risk, that is why we are charging more premium. What are the questions here? That how long should be the measurement period? Should geometric mean or arithmetic mean should be used? How we can measure this? Because we said that this risk free rate of return, or we can say the market risk premium, is determined historically. Then what is the period? How much should be the adequate period we should take to calculate this? And whenever we are talking about average, what kind of average we should take? Whether we should take a geometric average or we should take a arithmetic average, because once we take this different type of different techniques to use, or we always use the different techniques to calculate this average, then the results will be different. So, that is why the confusion always comes to the mind of the investor in the practical world. How generally, what can be the better proxy first to risk free rate? Then once you decide what is the risk free rate, then whenever you talk about the premium, then how much period data you should take, and once the data is also taken, then to average this particular data over the period, which kind of average we should consider, whether it is a geometric mean or whether it is a arithmetic mean. So, that is the questions always comes to the mind, but for your understanding I can tell that always the arithmetic mean is used, because that is easy to use, and the measurement period basically depends on the availability of the data. More the longer period, more the accuracy will be there. That is why what we can see, already I told you that the risk premium is basically endogenous variable which is determined by the certain factors. And what are those factors? These factors are basically the variance of underlying economy, the political risk and the market structure. If you observe that the risk premium of a particular market is totally, or we can say in a larger extent, explained by certain macroeconomic variables. Which are those macroeconomic variables? The macroeconomic variables can be growth rate of the GDP, it can be inflation, it can be the international scenario, or we can say our balanced trade balance position in the economy, or we can say it is the industrial production rate, or we can say it is the even there are certain variables like if you talk about the commodity market, then the rainfall is also a factor. So, there are certain factors who basically affect the risk level of this particular economy, a change in interest rates, change in expectation of the people, change in the sentiments of the people. So, any particular variables which is the contributing factor of the variability of the market, either it is inflation or the price stability, or it is growth rate of the GDP, or it is anything else, that basically says that how much risk the economy has now and how much risk the economy is going to face. So, if those variability are more in terms of the macroeconomic sense, then what will happen, that automatically the investors will always feel that once we are operating in a risky environment, the premium also we should get more. So, once their expectation is there to earn more premium, because market is volatile, because economic scenario is volatile, then what will happen, automatically the premium also will increase. And another thing is political risk, which is a very much important factor for either Indian context also, because if we do not have any political stability, if whole political instability is prevailing in the market, there is no such kind of uniformity in the policy structure, then what will happen, that because of the different attitude or different policy making decisions by the different governments, the variability or the sentiments of the people will be changed. If the sentiments of the people will be changed or the market scenario will be changed, and because of that the international relationship in the globalized market also will be changed, then what will happen, the risk level of the economy also will increase. If again the risk level or the risk appetite of the economy will again increase, then it is very difficult to again operate in that particular environment, because the environment is already volatile. So, in this context also the risk premium increases, because the investors always demand more risk premium, because they are operating in a highly risk environment. Then the market structure. What do you mean by the market structures? You see that whenever you talk about the market structure, market can be a monopoly market, market can be perfect market, market can be very much efficient market, market can be inefficient market. So, here if you observe, your market is very much efficient. Already we have explained what do you mean by the efficiency of the market. For example, your market is totally efficient from the information point of view. Then the confidence of the investor on that particular scenario will be more. If the confidence of the people or the confidence of the investor on the market will be more, because they assume that your market is an efficient market, then maybe it will have the impact on the premium. They may not charge that much premium, because already this return is assured from the beginning, because the risk level will decline if your market is more efficient. But if your market is inefficient, then definitely they will be expecting that they should get more return, because they are going to operate in a very uncertain market or uncertain environment. If the uncertain environment we are going to deal with, so in that particular scenario what will happen, that the return also will be varied. Therefore, what we can say, that always the market structure has the impact. And another way, already told you that if your market is a highly perfect market, everybody has the same information, a lot of buyers and sellers are available, and what we can see, that there is no such kind of market forces, there is no such kind of outside forces or external forces which can regulate the pricing of the particular asset. So, that particular, this is the typical characteristics of the perfect market condition. If your market condition is perfect, if you are operating a perfect market condition, obviously the confidence of the people or the investors will be more on the market. If once they are more faith on the market, that means once their confidence level increases, what we have seen, the risk level also will decline. If the risk level will decline, then definitely the risk premium also will decline, because they do not want to get that much premium what could have been there if your market is more uncertain. Therefore, we can say the market structure is also quite important. And another observation nowadays people talk about, that we call it market microstructure. What do you mean by this market microstructure? The market microstructure is basically deals with the transaction cost. You see that this is also one of the contributing factors for the risk level and as well as the total cost what the particular investor is going to face. And another way also we can say, it is basically nothing but it deals with the bid ask spread of this particular market. So, if the transaction costs are quite high, and when the transaction cost will be quite high, when your market will be inefficient. When your market will be inefficient, we know that the market will be inefficient when there is a huge information gap between the different stakeholders in the market. So, if there is a huge information gap, that leads to increase this inefficiency in the market, and that inefficiency increases the transaction cost. If that increase the transaction cost, automatically the bid ask spread will increase, then automatically it will have the impact on the risk premium. So, therefore, what we can see Sometimes because of this uncertainty in the market, not only in the equity market, but also in the bond market also, if the investors are ready to invest in the bond market, because of high inefficiency in the market from the information point of view, or because of the huge information gap between the different stakeholders or different people or the different participants in the market, then it also affects this interest rate level in the market. If once the interest rate will be affected by that, then what will happen, that automatically the bond price movement will be there. If the bond price movement will be there, the people or the investors who want to invest their particular money into the bond, their appetite, their sentiment, their confidence also changes because of the high fluctuation in the interest rates. In that scenario, what will happen, that what we can observe, that always that will have the impact on the risk premium. These are the different characteristics or different functions which basically affect the risk premium level, and if you observe the different literature, most of the literature talks about that the risk premium varies from country to country, risk premium varies from economy to economy, depending upon their political stability, depending upon their market efficiency, and as well as also the some of the issues related to the economic variables fluctuations. You just take the example of the subprime crisis. Because of the subprime crisis, the risk level of the particular or the risk appetite of the investor basically is affected by that. How it is affected by that? But the investor feels that now the market is more risky. If they are going to invest in the more risky market, so obviously if the premium is not that much high, they will not be investing in the market. If they will not be investing in the market, then what will happen? This price level will be unstable, which is happening in the USA and other countries, even including India. What we have observed, that because of that crisis in the market, it will have the larger impact on the different market, including the equity market or any other market. Therefore, what we can say, the major factor who affects this risk premium is related to the macroeconomic factors or the factors which is varied on the basis of the economic sense or from one economy to another economy. So, therefore, it is for your reference what you can see here, that there are certain calculations was Professor Ashok Damodaran has calculated. Here if you observe that he has calculated that the emerging markets with political risk, they have seen that South American markets in China and Russia, if you observe, they have premium around 7.5 to 9.5, and this calculation is based on the difference between the return from the risky return from the risky assets and the government bond rate. Then if you observe the emerging markets with a limited political risk, Singapore, Malaysia, India, Thailand, then we have around 7.5%. This data is basically 2002, 2003, whatever we talk about. Then the developed markets with wide stock listings like USA, Japan, UK, France and Italy, because their market is quite efficient in that way, and as well as also they have more number of companies in that listing process, and there is less information gap between the different stakeholders of the company. So, here if you observe, their premium is around 5.5%, but the developed markets with limited stock listings and stable economies like Germany and Switzerland, and there it is around 3.5 to 4.5%. So, if you observe that wherever the political risk will be more, wherever the information gap will be more, there you will observe that the risk premium also will be more, but wherever the political risk will be less, the information gap will be less, and as well as what we can see, that what we have observed, that the income variability of the country and as well as other economic variables like inflation, then we can say industrial production, agricultural production, etc., are more or less stable. In that countries also the risk premium are less. So, therefore, it is one of the major concern for any economy to know that how the risk premium is calculated or which are the factors which affect the risk premium. So, the another variable already I told you that that is your market risk. and the market risk, or we can say that is the systematic risk what we talk about. You see that systematic risk is measured as beta. Beta is equal to your systematic risk. If beta is equal to your systematic risk, so then what we can see here, that how this beta can be calculated. Already what we have seen, that beta is calculated in this way, that covariance between the individual stock with the market portfolio divided by the variance of the market. This is the way basically we can calculate, but basically what we can see, the easiest way of using this is generally you just take the return from the stock, individual stocks return I, then this is your market return. So, if you have the column of data, for example, you are taking data, monthly data, January 2009, February, March, April, like that, and here also the market return, you can say either BSE Sensex or NSE Nifty. These are basically the different proxies what you can use to calculate the market return. So, here if you also take this January, February, like that, then you run this regression between these two, defining this model, which is defined as your RI is equal to alpha plus beta RM plus the epsilon. So, here the coefficient what you are going to calculate, that is nothing but the beta. So, if you are taking this monthly data, we call it monthly beta. If you take the daily data, we call it daily beta. If you talk it yearly data, then we call it yearly beta. So, like that what you can do, you take this function in this manner, and if you observe this function in this manner, then gradually what will happen, that it will give you whatever coefficient, regression coefficient you will derive from this, that regression coefficient will give you the beta. So, here in this case, this particular model or this particular function what we have specified, or what we have specified to derive this beta, this particular function is defined as the characteristics line. So, here the systematic risk input of an individual asset derived from a regression model, already I told you, referred to as the asset characteristics line with the market portfolio. So, this is your R is equal to alpha plus beta R m plus epsilon, and epsilon is the error term what always we take in the statistical function, because we cannot incorporate other variables which affect your return from this particular asset. So, basically the u or the epsilon which incorporates the particular factors we do not consider in the model. So, this is the way the function is different from a mathematical function. If you want to derive it in a mathematical function, basically R I is a function of beta, which is a mathematical function, but if you talk about R I is equal to alpha plus beta R m plus u or epsilon, then this particular function is a statistical function, and statistical function basically is we can say or mathematical function is a deterministic function, and statistical function is basically a stochastic function. Mathematical functions are always deterministic, it has a definite answer, but statistical functions are basically not deterministic, it is stochastic in nature, and it depends on the number of variables what we are incorporating in this case, and the particular variables which you could not incorporate in this case, that will be reflected in the error term what we have taken in the end. So, your alpha is equal to R I minus beta into R m. So, basically this is the excess return what we are going to get, or this is the intercept always in our line, because this is the line always we draw in this case. So, if you talk about this line, so this is your, this part is your RF, or we can say this is your any line, this is your alpha, the excess return. So, already we have seen this particular equation before whenever we talk about the security market line. So, here this particular beta equation is nothing but this is the risk free rate of return plus this is your this covariance I m divided by the variance m, that will give you the beta. R m minus R f will give you the risk free market risk premium, then this is the beta, this way this is calculated. Then what is the covariance R I into R m? This is already we know that is the summation of the R I minus R I bar. R I bar is nothing but the mean of this expected return from this particular asset, and R m bar is nothing but the mean of this return what you are getting from the market portfolio divided by the n minus 1. N minus 1 is the degrees of freedom. Then this is your variance. This is basically R m minus R m bar. R m bar already I told you that this is the mean of the average of this particular market return divided by n minus 1. Then if once this thing will be calculated, this thing will be calculated, the beta also will be calculated, but the best way of calculating beta is calculating this using this regression line. And how this estimation of the beta is done? There are various practical issues. Already told you that you take this one column, you take the return from the asset, and another column you take the market return, and you run the regression between these two, and whatever regression coefficient you will have, that basically calculates the beta of this particular stock. But there are certain practical issues involved in this case. What are those practical issues involved in this case? That first of all, what is the data, how you can calculate this data, what is the period of study and how much interval you should take, whether you should take daily data or you should take monthly data or you should take fortnightly data or you should take yearly data. That is a fundamental question always comes to mind of the investor, that what should be the return interval. The interval should be either daily or monthly or quarterly. The next one is the market index, which index we should use. In India also whatever we have BSE Sensex, we have NSE Nifty, we have other indexes whatever we have. But here the question arises, does those indexes really reflect the market portfolio, or out of these 6-7 indicators whatever we have, which indicator is the best indicator? So, that confusion always there in the mind of the investor, what particular market index should be used for the analysis to calculate the beta. And second question is the fundamental question already what we have raised, that out of these 4-5 indicators which one is the best, that is number 1. Number 2, whenever we use those either of these 5-6 indicators, which one whether really is the best indicator of the market portfolio, and does this all these 6 indicators, and out of these 6 indicators any of them is really reflecting the market portfolio. So, these are the fundamental questions always comes to the mind of the investor in practice whenever they calculate the beta using this regression concept or using any of the formula based way through which always we want this variance of the market portfolio as well as the return of the market portfolio. Then another one is your adjusting to historical beta. What do you mean by this adjusting to historical beta? Because sometimes the measurement of past relationship cannot be used as an estimate of future risk. The historical alignment may have been significantly influenced by chance of factors. Companies beta may change over time, require a voting scheme. You see, these are very important points. What you just see this particular case. We are using the return of a particular stock, or we are using certain things to calculate the beta historically, but the companies or what we talk about the unsystematic risk of the company varies from time to time. If the unsystematic risk of the company will be varying from time to time, then how generally those things will be adjusted into this particular data. Because whenever you talk about the beta of the particular stock of this particular period is this much, but the whole of the period is not uniform, because there are certain things which was happening 1 year back, the same thing is not happening now, or in a particular level the unsystematic risk was quite high for this particular company, therefore, the return was affected. Maybe that unsystematic risk is not prevailing now. So, how those factors will be incorporated whenever we do the beta calculation, that is number 1 question. Number 2 question, that even if those calculations will be done, then how this can be incorporated into the model, how this adjustment can be made, because this changes over time which basically reflects on the data set. It has the reflection, but actually how we can derive this reflection, that is practically is not feasible. Therefore, some of the people have highly criticized how we can incorporate this. If you want to incorporate this, then how this adjustment can take place, and if you want to do the adjustment, then for the different periods to calculate the beta, the different weighting scheme should be given, the weighting assignment should be given, but what is the criteria to provide this weightage? That identification of that criteria will be quite difficult. If once the identification of the criteria will be difficult, and first of all the identification of the incident also will be difficult, because over the period of time so many things is happening to the company, so many events, so many incidents, so many different type of risk, what different type of risk the company is facing, then how this adjustment can be made and how this weighting scheme can be decided. So, that these are the different questions basically comes to the mind of the investor and as well as the researcher or the people or the academician to how to adjust this beta. So, therefore, sometimes we face the problem regarding that, but it is always required to do that. What are the other approaches to beta estimation? Other approaches are betas based on fundamental information. You just talk about the industry affiliation, you see that what is the industry beta of that particular. For example, here is a company belong to manufacturing company. So, you just see what is the beta of this particular industry in the particular period. So, that beta can be used as a proxy for that particular company, but which is not again accurate. So, it is approximation data what you can calculate on the basis of the industry affiliation. Corporate growth, you just see that which one is the high growth company, which one is the low growth company, and the beta of a high growth company is this much and the beta of the low growth company is this much, then we can consider always that is one of the way through which you can anticipate, you can say that this much should be the beta, because this much beta is prevailing for other company which is a high growth company. Financial leverage, you see leverage is a major factor who affects the beta, that is why we always call it that is a levered beta, there is a unlevered beta. So, if your beta, your levered value will increase or debt by equity ratio will increase, then the beta may increase. So, therefore, what we can say that always we should consider then how much leverage the company has, and if the leverage is increasing, how this particular beta value is increasing for this particular company. So, that is also one of the indicators always we should see. Then the size, that means the beta is determined by the size, the beta is determined by the growth of the company, beta can be also determined by the leverage of the company and as well as size of the company. There are various factors, that is why a formulation can be made, a model specification can be worked out whenever we define this beta, whenever we calculate this beta, and accordingly this particular beta can be used to calculate the expected return of the equity in a capital asset pricing model. Another way of calculating beta is based on accounting earnings. What does it mean? Basically, regressing the changes in company earnings against changes in the earnings for the market. So, whatever company earnings we have, you just regress it with the changes in the earnings for the market. In the whole market, what is the how this earnings percentage is there and how the total company earnings is changing in aggregate, and what is the earnings this particular company is giving. So, you also sometimes through accounting way also we can calculate beta by regressing these two variables, but again it has certain limitations, because all the company in the market are not affected by the same degree because of certain changes in the market, and the particular company which is affected by certain variables, maybe other companies are not affected by that. Betas from cross sectional regression, how generally we do it, the coefficient of variation of operating income, debt to equity ratio, earnings growth in total assets. Basically across the company, what do we mean by the cross sectional? It is basically the over the companies how this particular beta is changing, and over the companies which are the variables which is affecting the beta, it is basically the operating income or the risk, variability of the operating income or the volatility of this particular company, as well as the financial position of the company, which is or the financial leverage of the company, which is measured as debt to equity ratio, and as well as also you have the earnings growth, how much prospects are there, how the company can grow further, that is also one of the variables which can calculate your beta. And finally, the total assets, how much is the fixed assets, how much is the variable assets, how much is the actual physical assets, and how much is the intellectual capitals, or what we can say this knowledge based capital whatever the company has. So, these are the different variables which also determine the beta in a company's case. So, all you should observe one particular thing here, you just see that to calculate the expected return of the equity, we need capital asset pricing model. But whenever we talk about the capital asset pricing model, there are certain inputs we need, there are certain variables we need to use this capital asset pricing model. And what are those particular inputs are? The inputs are either it is systematic risk or the beta, or it is we can say market risk premium, or it is the risk free rate. So, already I told you risk free rate, you can take any of the proxies, either it is a government bond rate or it is treasury bill rates, etc., etc. But whenever you talk about the risk premium, there are certain variables which affect your risk premium like anything, that is your variability of the market, variables like price, like your growth rate of the GDP, industrial production, etc. But again, whenever you come back to the beta, there are certain thousand variables, with some variables specific to the company like your size, like your profit, like your growth, like your leverage. But there are certain variables which are affected by the industry, and there are certain industry dynamics has a lot of impact to performance of the company or the systematic risk, to measure the systematic risk of the company. And as well as also we have other variables like certain variables like your whole macroeconomic scenario, like the same variable like inflation, GDP, etc., also play the significant role. So, we have certain variables which are company specific or the firm specific, there are certain variables which are industry specific, there are certain variables which are macroeconomic specific. So, we have to incorporate all those variables to calculate the beta, and we have incorporated certain variables to calculate risk premium. Then finally, whatever risk free rate whatever we have, then only the capital asset pricing model can be used to know the required rate of return from a particular risky asset. So, this is the way what I explained, that first of all what we do, that we first this is the model whatever we have, that is your expected return is equal to R f plus beta into expected return from the market minus R f, which is your risk premium, and this is your systematic risk, and this is your risk free rate. Then now what you can do, the first step is set up the sample data. First we can set up the data, then we estimate the security characteristics line, which this is the function RIT is equal to this is the intercept, and this is the regression coefficient, which basically gives you the beta, then this is the UIT. Then once the beta value will be calculated in the time series part for all the companies. For example, we have 50 companies in our set 1 to 50. Then whatever we have let data for monthly data we have for 1 year, January, February to December. Then what we do first, for first company we run this regression, RIT is equal to AIT plus BIRMT plus UIT. This is the characteristics line. For the second company again we run it, third company again we run it, like that on the 50th company also we run it. After running this, from this regression we can calculate your beta, which is your B. And once these betas are calculated, these betas will be used as the independent variable in the second equation. In the second equation what we do, we calculate your RIT minus RFT is equal to AI plus BI into RMT minus RFT. So, this beta whatever we have, this we use in the second equation in the cross sectional way. So, you have beta 1, beta 2 to beta 50. So, this beta 50 will be, you can use this, or you can also use this function RF RI is equal to AI plus beta RM minus RF plus U. So, once the second regression we run, the second step regression we run, here your beta is equal to your independent variables, and Ri is equal to your dependent variables. So, therefore, whatever coefficient you will find, that coefficient is basically Rm minus Rf. So, that is basically the risk premium. So, in the first regression, which is a time series part, over the period we have to run this regression in the company wise, and second part whatever we are doing, we have this series of beta ones what we calculate from this regression, and this beta will be used as independent variable in the second step, and therefore, if you run this regression, whatever coefficients you will derive from this, that coefficient is nothing but that is the risk premium. So, this is the way generally if the total risk premium whatever we can calculate from here, that will be really exactly equal to the risk premium what is prevailing in the market, then that particular thing is defined. Then we can say the capital asset pricing model holds good. Then after discussing these things already what I told you, there are we can also relax certain assumptions from this, because already we have seen that the borrowing and lending rate are same whenever we use the capital asset pricing model in the beginning in the assumption what we have taken, what we discussed in the previous class, and that borrowing and lending also takes place at a risk free rate. And also what we have taken that the expectations are homogeneous, all the people expect in the same direction and their expectation level are same, and also the planning horizon, the planning period will be same, because everybody wanted to invest in the same period, the time horizon is constant over the investor. But here in practice if you see that always we have differential borrowing and lending rates, and the expectations cannot be same by the different investors, and the planning periods also will be different. If the borrowing and lending rate will be different, then what we have we can see, once your borrowing and lending rate will be different, you may not find a line like this, you may find a line like this. We may find two lines, one line for borrowing, another line for the lending, because if the lending and borrowing rates are different in this case. Like that, if the expectation levels are different, then from a single asset all the investor may not expect that whatever return they are going to get or they are going to expect, it is same. So, that is why once the expectation level will be different and the lending and borrowing rate will be different, then whatever way we have defined the capital asset pricing model or the capital market line, the same way it cannot be defined, because already the functions may be non-linear also. In the beginning we have assumed that is a linear relationship between beta and the expected return of the stock, and beta is the factor who affects the expected return, or the risk premium which affects the expected return, or it is the risk free rate who determines the expected return. But that relationship may not be linear also, there may be some non-linearity is existing, there must be some dynamism is existing to calculate the expected return from that particular stock. Therefore, once your heterogeneous expectations will be there and it varies from investor to investor, once the planning period, the time horizon will be different, then obviously what will happen, this capital asset pricing model may not hold. Then we have another model what we call it the zero beta model, and here the zero beta means it does not require a risk free asset in the particular case, and all the assets whatever we are talking about, that basically talks about the risky assets only. Then here also what assumption we have taken, there is no transaction cost, which is very unfair to assume, because any investment whatever we make in the market, that basically involves the transaction cost. If you incur the transaction cost in each investment process, then if you ignore the cost which is in by defined transaction cost, which is very difficult to do, because that is the major cost always we face in the market. So, therefore, with transaction cost, the SML or CML will be a band of securities rather than a straight line. So, if there is a transaction cost, then obviously the cost part will be changed. So, it may not be a straight line, it may go for a band. So, therefore, what we can say, once we relax the assumptions, whatever way the capital market theory, whatever way the security capital asset pricing model is defined, the same way it cannot be defined, or there are certain limitations about that, and there are certain unrealistic assumptions whatever we have taken, that basically is not practically feasible. So, it will have the impact on the CML, SML already what I told you, that because the expectations will have the different implications of the people, and it could cause the major differences in the CML and SML if the tax structure will be there. Because if there are different tax structures, sometimes we need dividend, sometimes we need capital gain, if there is a difference between the tax structure. So, sometimes on a particular period, if some relaxation will be given for a particular level of income in terms of the tax, then people also the expectation level will be changing, the time horizon will be changing, and depending upon that the expected required return from that particular asset or the particular portfolio also will be changing. Therefore, tax will have the more impact also on the process. So, there are various people throughout the world have done this empirical testing of the capital asset pricing model, and then what kind of relationship and what kind of results they got. If you observe those results, basically what we have seen that the betas for individual stocks are not stable, but portfolio betas are reasonably stable. Further, the larger the portfolio of stocks, the longer the period, the more stable the beta of the portfolio. Already I told you in the previous class that longer the period, longer the time horizon, we have the accurate results. The accuracy of the results will be more if you have sample size will be more, if your time period will be more lengthy, because in the equity market basically always we deal with in the long run phenomena, or we should expect that some good return from the equity market or the stabilization of the equity market if you want to stay in the market for a longer period of time. But if you cannot stay in the longer period of time, if you do not deal with a long run concept of the equity market, then it is very difficult to calculate the required rate of return, or we can say the stability of this particular return or stability of the systematic risk, what we are going to get whenever we take it for our investment use. So, that is why the stability of the beta, what do we mean by the stability of the beta? Because beta is determined by certain factors whatever we have seen, and those factors keep on changing in the short period, but in the long period of time if you observe or the periodically if you observe, then there are certain variables which affect always beta, which always determine the beta uniformly. Therefore, we can say there is a stability in the beta for a long period of time, but that stability is missed out, the stability misses whenever we talk about the short run phenomena. Then comparability of published estimates of the beta, there is a different, because we have already the published data in the various form, maybe monthly or quarterly or weekly beta. So, whether these are really relevant to be used or not. So, that differences, that opinion differences are existing. So, therefore, they consider the return interval used in the firm's relative size, or you can use also your own beta calculation, you can do the beta calculation on your own, and after that those beta can be used for your investment reasons. You may not rely on the publishable data because they may not use the philosophy or the expectation what you are trying to use. So, there is a relationship between the systematic risk and return. If you see that the effect of skewness on the relationship, investors prefer stocks with high positive skewness that provide an opportunity for every large returns. Sometimes the investors expectation also very peculiar, because sometimes if they will observe that one particular return is skewed positively, then they always feel that that particular momentum will go on for this particular stock and they are going to get more return out of this, and accordingly the other systematic risk and the return also will be affected. Once the return will be, the expectation will be changing, it will have the impact on the risk and return. So, there are other people also, they will have some decision making process in terms of the size of the company, the price earning ratio and the leverage, because size and price earning have inverse impact on the returns after considering the capital asset pricing model, and financial leverage also helps explain cross section of the returns. That means, the other factors which could have the impact on the return already we have seen in the various models, what we will discuss extensively further in the other sessions, that we have the variables like size, we have the variables like price earning ratio, we have the variables like leverage, which also could have the impact on the expected return of the stock, and those variables are not incorporated in the capital asset pricing model, and therefore, certain investors also decide those variables while investing, but it was not there. So, therefore, what we can say, these variables also play the role for the calculation of the expected risk and return for the particular asset or particular portfolio. So, that also should be taken into consideration whenever we deal with those kind of assets. So, therefore, always we have seen that, or in USA context whatever we have seen, the larger size companies always perform slower than the small size companies, or we can say the companies which have low price earning ratio, they performs better than the high price earning ratio. So, that particular things also can be prevailed in the context of other countries like India, and we can check it out those things also. So, whether this same phenomena is really prevailing in this particular market or not, or is there any other phenomena which is prevailing here. So, that is the matter of discussion, or the matter of issues to be discussed in various cases. Then another variable also what we discuss in the further classes, but here I will just give you the hint that Fama and friends questioned the relationship between the return and beta in their seminal 1992 study. They found that the book value of the stock to market value ratio to be the key determinants of the returns. Like your size, like your price earning ratio, like your leverage, we have also the other variables whatever we have. The other variables are nothing but these are variables what we talk about. These are basically the market value to the book value, or book value to the market value. These are also the important determinants which affect the equity return of the particular stock. So, that Fama has explained, and further whenever the multiple or we can say that the arbitrage pricing theory or the multi-factor model we will read, or we will discuss, then only we can come to know in the detail what exactly the Fama was trying to say, and what could be the real important variables which have the impact on the expected return of the equity. So, the relationship between beta and the rates of return is a moot point, although beta is a factor, but still the debate is going on whether beta is the only factor or there are other factors and beta is one of the factors. That thing we have to see further. So, the market portfolio what generally we have discussed, and there is a theory versus praxis, there is a controversy over the market portfolio, which proxy should be used, that already I told you. There is no unanimity about which proxy to use. An incorrect market proxy will affect both the beta and risk measures and the position and the slopes of the SML that is used to evaluate the portfolio performance. That already we have explained in a larger extent. Then the criticism already we have enough, we have also discussed little bit in other slides. It is criticized because of the difficulties in selecting a proxy for market portfolio. It is also an alternative pricing theory with fewer assumptions was developed, because most of the assumptions were very much unrealistic, and sometimes also in the market we have arbitrage opportunity. What do you mean by the arbitrage opportunity? Maybe sometimes we take position in the two different markets, and that two different markets whenever we take, in one market if you take a position and where the price level is low, in other market the price is higher, then what we can do, somewhere whenever it is low we will sell it, we will buy it there and we will sell it wherever the price is higher. So, in that case what will happen, that without any risk we get some return. So, that we concept we call the arbitrage pricing, and that part plays the significant role for the expected return of the equity. And here what we can see, that most of the market it happens, or we can say that in the market where the law of one price does not prevail, that market is basically there is arbitrage opportunity is prevailing in that market. So, that part also should be taken into consideration whenever we talk about the calculation of expected return of the equity. So, these are the various issues emerged from the capital asset pricing model, but whatever it may be, maybe there are huge amount of the limitations the capital asset pricing model has, but this is the most significant theory, more prominent theory, which is the founding theory, which talks about, which still helps us to calculate the expected return of the equity. Maybe the advancement of the theory it is prevailing, but still we are using in most of the cases the expected return of the equity is calculated using the capital asset pricing model. But once we talk about the limitations of this model and how the other models really helps to remove those problems, that we will see in the next sessions. Thank you.